Welcome to the insurance series. If you haven't joined us for one of these before, this is a series of free webinars giving you an insight into what insurance is and what kind of cover you and your family may need. Now, today is part 3, and we will be discussing whole of life insurance. But before we do start, please allow me to introduce myself for those of you who don't know me already. My name is Michael Christophis, and I'm a senior associate at Holborn Assets, and I've been giving advice to expats for over 15 years on their finances and protecting their futures. Whether that may be investments, savings, or insurance, I'm here to help. Now, today I have the pleasure of having with me Richard Williams from Continental. Richard, do you just want to introduce yourself a little bit?
Yes, of course. And thanks for inviting me along today, Michael. It's great to be here, and thanks to everyone for tuning in. I am based in the UK, although I'm affiliated to our Geneva office. I've been in the industry since a staggering 1987, and I was an advisor for many years with Lloyds Bank, private banking in Jersey, and then latterly in the Middle East. And in terms of Continental, I've been with them for 8 years. I focus primarily on protection solutions, and life insurance isn't the most exciting thing in life, but as you know, and I know, both of us are fathers, it's a necessary aspect of the whole holistic planning service. So it's great to be here and great to see everyone. And Continental has been in the business for 30 years, and we have a very, very close relationship with Michael. And as such, I hope I'll add some value to our discussions today.
I'm sure you will. And as I said, it's a pleasure to have you. So as you all know, today we will be discussing whole of life insurance. Now, there will be a live Q&A at the end. So if you do have any questions, please just click the question box, put them in there, and we will answer all of them at the end. I know some of you have registered with some questions. They're already in the Q&A list. So please hold out until the end and we will answer them for you then. Okay, Richard. Whole of life insurance really is the hidden gem of the insurance world that many people do not know anything about. So why don't we start really easy, and why don't you just explain what is whole of life insurance?
Well, what is whole of life insurance? Well, first of all, as I mentioned earlier in the introduction, insurance is quite a boring subject, but the whole of life aspect is actually quite interesting. And I like whole of life insurance because ultimately I know that I, you, all of those that are tuned in today will one day pass away, but we just don't know when. And someone said to me once, if you knew when you were going to pass away, would you want to know? And my answer was very simply no. Okay, so why would you do a term insurance policy? In other words, a policy that finished maybe when you're 65 or 70 or something like that. It's probably when your family need it the most for whatever purpose they're using it for. So a whole of life policy is one that lasts for the entirety of your life. It will pay out when you die in the future. We've all had experiences in our lives. My sister sadly passed away when she was 30. My mum still drives and doesn't wear glasses today, and she's 89. We just don't know when these things are going to happen. So a whole of life insurance policy is one that has 2 components. One is the life insurance aspect, which lasts the rest of your life. And the other, unlike a term insurance policy, is an investment component that will grow and grow and grow. So later on, when someone says, I don't need this insurance anymore, they can cash it in to pay for school fees or whatever. But all we're doing here is we're passing on risk management from the policy holder's pockets to an insurance company who's got deeper pockets, so that when that person passes away, the financial catastrophe can be avoided for the rest of their family and beneficiaries.
Obviously, you've mentioned there a little bit about an investment component, and we'll get onto that in a moment. But what makes a whole of life policy different from a normal standalone insurance, other than the age, the time that it will mature? What else makes it different? Sorry.
I think the investment side, which we'll get onto, is quite an exciting part because it is part of the financial planning. It's what someone's going to use it for. So, it is should be looked at as a utility, a moral obligation. It's bought, it's not sold. It can be used in the right circumstances, perhaps for inheritance tax planning. Obviously, everyone's circumstances are completely different, and we always say seek professional, qualified tax advice. But some people would use it to help mitigate those taxes in the future. So there are all sorts of different uses that you can have. You could have it as a key person insurance. In other words, if a key person within the framework of a big company passes away, it means that they have money, they have liquidity, so they don't have the banks chasing them for any debts, they don't have the competitors muscling in, and they keep their clients. So ultimately, what we're looking to do here for the rest of someone's life is allow, put it bluntly, a boo-hoo when someone passes away, but having life carrying on as normal as possible from a financial perspective for those that are left behind. And as I said, you and I, we both have families, we're both married, we love those we are with and our children, and we just want them to carry on having a great life. So it's a great way to manage predictability in an unpredictable world, whereas term insurance is a temporary solution to a permanent problem. We are going to die. We just don't know when. And that's what is the edge that a whole of life policy has.
Okay. And you mentioned a little bit there regarding key man insurance, etc. But why would anybody use a whole of life insurance policy?
Simply because with a whole of life policy, the company is adding an asset to their balance sheet. So, for example, someone may say, well, I want to insure myself for $5 million as a director. So when they pass on, that will go to the company. But equally, they may say further down the line, we don't need all of that life insurance, so we can take some money out and put it back into the company. A term insurance policy is more like car insurance. You insure your car, you don't crash it, you don't get your money back. In this case, you insure your person and they die and you do get money back, but also if they suddenly decide, well, we don't need that, you can take money out of the policy. So it's more versatile, it's more manageable, and it's an asset that continues to grow. And so we always say clients should think of their premiums as working capital. The here and now, you're protected, you're safe, your family are going to be all right, but in the long term you may have different sets of circumstances. So it just allows, from a financial aspect, you to have liquidity in the pot so that can happen. But the thing we don't know is when someone's going to die.
Yeah, of course. I mean, if we knew that, we'd all be rich, wouldn't we?
Yeah.
So you did mention there a little bit about inheritance tax planning in there. In what way can this sort of policy help with inheritance tax planning?
So entirely dependent upon where someone lives, and I think it's a brave person who says a sweeping statement that this avoids inheritance tax, because it doesn't, because it's wholly dependent on where someone lives and where their beneficiaries live. But in the right hands and perhaps in the right structure, whether that's in the framework of a company holding the policy or a trust holding the policy, it generates immediate capital in the event of someone passing away, which can then be tailored and used to offset inheritance tax charges. But as I say, there's no one rule for everyone. It changes very aggressively. And as we know, sitting in the UK, they will tax you in any way they can. But it's that immediacy of raising capital. So you don't have to sell the family silver or the family home or the business. And you don't have people squabbling around looking for money, because the policy is generating a huge amount of money in the event of someone's death when they die.
So essentially what you're saying there is let's say, for example, a client or someone listening has property that has a mortgage on it, let's say a large property, they can essentially take this insurance out rather than taking an insurance on their home. And if something were to happen to them and they passed away, this insurance would help cover the cost of the shortfall in the mortgage and could potentially still have cash in the pot as well.
Absolutely. Yes, indeed.
Okay. So I think the difference there between standalone insurance and this is there's essentially going to be a bigger pot. It's a bigger insurance. It's going to cover you for a little bit more, which is why we would obviously recommend people taking this out for the higher levels of cover rather than the lower levels of cover.
Absolutely right. Yes.
So just talking about the money in the pot, can you explain a little bit how the investment side of this insurance works?
Well, yes, absolutely. And this is the bit I really like. And so I believe life is all about how much sleep you get. And I've got friends who are traders, who are oil traders, stocks and shares traders, and they're having a bit of a rocky time over the last few years. And all the while we've seen markets move in the right direction, but you only need something to glitch it, and then we're all into the world of volatility. So there are two types of whole of life policies with an investment component. The first is called a unit linked whole of life policy. And within that, a portion of the premium goes towards the cost of the insurance, and a portion of that goes towards the investment. And ordinarily what happens there is the advisor or the client will say, well, I want a bit of Japan, I want a bit of a balanced managed fund. So in other words, they are choosing the underlying investment component. Now that's all great when the markets are doing well. But similarly, we never know what's around the corner. We've seen quite a lot happen. 5 or 6 years ago, I'd never heard of COVID. And look at all the things that have happened since then and are ongoing right now as we speak, to name a few. So that brings negative volatility potentially. The other type is what I focus on every day of my life, which is called universal life insurance. Now that's slightly different because it removes the necessity for the advisor or for the client to actively manage the underlying investment component. And I'll tell you why. So typically, it will track an index, such as the S&P 500. And we know what that's done since 1957. It's gone up by 10 or 11%, and we adjust that for inflation to around 8% a year. But it's done pretty well, and it's very well respected. So the investment component will track what that market is doing on a year-by-year basis. And then whatever that market has done will be added to the policy. But here's the thing, and if you only pick up one thing from this discussion, this is it. When the market drops, the investment component doesn't go down. In fact, it marginally goes up 2 or 3%, dependent upon the insurance company that we're using. And that's because it's tracking the index. It's not actually investing into it. So we're going with some of the biggest insurance companies on the planet. The investment component is going into an internal pot with the insurance company, which typically is into income generating assets, allowing it to capture the upside of the market, but be protected from the downside. So you're removing all that volatility. Why would anyone take a risk with investments in line with the people they love the most, our wives and children? Conversely, there is normally an upside cap. So, for example, it's normally between 10 and 11%. So let's say 10%. So if a market went up 15% in a year, a client might get 10%, not 15. But if the market dropped 15% a year, they don't go down. So the beauty there is you're enjoying the good days. You're having all that compound interest. Einstein said the eighth wonder of the world is compounding. Those that understand it, earning it, and those that don't miss out. And that's the beauty and the difference between universal life, which is a whole of life policy, and a unit linked policy where you have to manage the good days, but also the bad days.
A couple of questions on that. You've obviously mentioned there's a cap. Does that cap sit above what the average of what, say, the S&P has done over the last since 1957, like you mentioned?
It does. It does. In most cases, it's between 10 and 11%. So yeah, it's pretty much bang on the money. And the other aspect, if I just think of one product provider that we use, when we actually provide an illustration, we don't need to punch the lights out to make this work and work very well. Our target is to make sure that at the age of someone being 100, the accumulated pot, if we call it that, the account value, is the same as the life cover. So if someone's set up a policy up for $5 million, by the time they're 100 years old, the policy is worth $5 million. So you're accumulating that asset. And to achieve that, generally, we only need to achieve about 5 or 6% with the S&P 500, which is pretty much half of what it's done. So I'm in a very fortunate position just now. So all the reports we're sending out for people that took these policies out years and years ago, they're miles ahead of plan, because the S&P has performed in line with what it's done. But we've not overpromised, but we have over-delivered, which is a nice place to be. And all around us, it's all a bit jumpy.
You also mentioned there before that if there's a downside in the market, the client is still getting some form of return. If the policy is set up correctly, are you essentially saying that their investment is guaranteed in terms of the money that they put into it?
So the overall money being put in wouldn't be fully guaranteed, and the reason for that is because you've got the underlying cost of insurance coming out, which is actually insuring them. But for example, if we go back to our unit linked whole of life policy where we're dependent on the markets, if the markets were to drop, let's say for 5 years or 10 years continually, the insurance company would come back and say, hey, this hasn't worked the way we are hoping for. We need some more money, please. Now, with universal life, you tend to find it can sustain no growth, typically for about 25, 30 years. Since the S&P was founded in 1957, there have only been 3 consecutive negative years, which was early 2000s. So it can easily sustain long-term guaranteed growth. And then we see the capital values coming up alongside that.
Yes, I do like the being tied to the S&P, and obviously having those not guarantees, but those aids that you have within the policy. They do really help the client secure their funds for the future. Now, in terms of paying for this, is there a predetermined payment schedule, or can it be paid for the whole of life? Can it be paid in one lump sum? How does it work in terms of the payment?
Well, luckily with universal life, which is a whole of life policy, it's a bit like going to your Bond Street tailor. I'm sure you go there because you're a very smart dressed young man. You can do whatever you want. You can tailor it to fit in with your circumstances. And typically these policies are always US dollar denominated. They can be funded on an ongoing basis until a client is 100. But typically I see clients want to get the cost out of the way. They want insurance for the rest of their life, but they want to get the cost out of the way. So you'd see that maybe being funded over 5 or 10 or 15 years, or maybe coinciding when they were planning to retire in 8 years. But you may find some clients come along and say, look, I've got a lot of money in the bank. I'm not getting a lot of interest. I want to enjoy the S&P 500's growth without the risk. I'll fund it with a single premium. And the benefit there is that working capital, the requirement is generally about 20 or 30% less because, of course, the insurance company have all their money up front. And that's quite a nice position to be. So the short answer is we can tailor it to anything your client wants.
Yeah, I think that's a really good point for people listening is if you do take a unit linked or just a life insurance that we discussed in last week's webinar, that flexibility isn't there. So if you do want a bit more flexibility, you want to pay from bonuses, etc., we can do that by using the universal life. Now, obviously, I've mentioned other insurances there. In terms of the care and obviously the end of life care, how does this insurance stack up compared to other insurances? And how can clients keep track of it and keep track of the investment that you've spoken about?
Yeah, no, very, very good questions. And I should also add that in most cases, clients can actually start dipping into their pot, typically from around year 11 up to, say, 5% of the pot without affecting their life cover. So you're actually using it almost as a bridge, maybe for some pension under planning perhaps. But back to your question, so if someone actually passes away, the best insurance policy is the one that pays out the most when it's needed, which typically is when someone passes away. I've seen insurance policies that haven't paid out for over 2 years because they weren't set up properly and they were being contested. So all policies are written within the framework of a trust structure, and the beauty of that is it avoids the necessity for probate. So typically the payout is within 30 days of someone passing away, and usually it's much sooner than that. So back to my earlier point, so that those people left behind can breathe, can grieve, and can carry on with their lives.
And how can they, I mentioned in the question, sorry, how can they keep track of the actual investment whilst it's live?
Forgive me, I didn't cover that.
No problem.
Every year they will get a policy overview, which is a report to saying this is what the S&P 500 did last year, and this is what it means for you. Here is your new policy value. But it will also show the initial illustration with which they made a decision to go ahead versus the in-force illustration, which shows, in today's market, they are miles ahead of what we said we were going to do. And in the current climate, that's not always the case, isn't it? Whereas here, we're safeguarding the client from any negativity in the market. And typically, these companies that provide this sort of insurance have been on the planet longer than our grandparents. So they're well-established Fortune 500 organizations that have a good track record on all the ratings you would die for. Excuse the pun.
Yeah. I have to point out there as well that clients do love the fact that you show the initial illustration compared to the current illustration. You don't get that in a lot of investments, offshore investments anyway. So it's quite nice to see the comparison of what's going on. I think you've really shown there, Richard, you've given us a lot of information, and you really have shown why this is the hidden gem of the insurance industry. But there is loads more information on this for those listening. So if you do want more information, please do feel free. There will be a QR code come on the screen shortly. Feel free to book an appointment or send me an email. We can even book a one-to-one meeting with Richard to go through his offering in a lot more detail. There obviously are other companies that offer whole of life insurance, or if you do prefer the unit linked or just life insurance, again, we are here to help with that. Now we're going to move on to the Q&A. But before we do, I just want a massive thank you to Richard, a massive thank you to all of you for joining us today. As I mentioned before, if you do want any help, any of your personal circumstances discussed, please do scan the QR code that will be on the screen shortly, or send me an email. And if you've missed any of our previous webinars, or you just want to rewatch this one, please go on to the Holborn Assets website, which is holbornassets.com, or you can find me on my YouTube channel, which is Michael Christophis Wealth. Please look for all those videos on there. Before I start the Q&A, I just want to share my screen so that QR code is on there. And I'll start with the questions. We've had quite a few. As I mentioned before, some of you did put questions in when you registered. So I'll start with this one first, Richard. At the age of 60, can I still invest in this type of insurance? And are there any special investment programs for short periods?
So the short answer to that one is yes, and we've insured people who are much older than that. And part of the process there is to identify someone's health, wealth, lifestyle, and their professional journey. And obviously we'll find out where they're living and do they smoke. But the short answer is yes. In terms of separate financial plans, any investments that are beyond the sort of the internal gubbins here of the S&P 500, you would do within the framework of another vehicle, and that's something that Michael can certainly help you with. But the short answer is absolutely. I'd also say we have had very favorable underwriters working with us. I can think of one particular client who was 67 in East Africa, and he had a suspected heart attack during his medical examination for the policy. And it turned out the doctor had found a condition this client was completely unaware of. He was a ticking time bomb. And I bumped into him by chance, and he said, it's only because I took out this policy that I knew this ticking time bomb was there, which I can treat with drugs. And he was 67. And he went ahead, and we got him insured, and he's still alive, and now his son's doing a policy. So short answer is yes, we can do it.
Yeah, just to touch on the age, most insurance companies, even if you're just doing a normal life insurance, will take you up to 69. And in terms of short-term investments, if you mean within this type of insurance, then of course we can set the payment up to be 1 day if the affordability is there, or if you're looking for short-term investments, we as a company have multiple short-term investments running anything from a day to 5 years, depending on what you're looking for and what type of return. But again, please scan the QR code or send us an email. We're happy to help. Next question. What is the minimum cover level?
So for a whole of life plan, a unit linked whole of life policy, normally it's around $100,000. For universal life, it's $1 million.
Yeah, so just what Richard's been covering today in terms of the universal cover and what he does is $1 million. But for any unit linked policies that we can do with other companies, as Richard mentioned, would be about 100,000. I think this question's been answered, but I'll just answer it again. The question is, can I choose the underlying investments? Richard touched on this before. If you take the unit linked, then yes, you can pick the investments. Obviously, they're restricted to what the insurance company that you take offer. But if you go down the route of the universal life with Richard, then you are pegged to a main indice, more than likely the S&P 500. But what that brings is a protection barrier from the upside, from the downside. And also it's capped at the top, but because that's simply so we can make sure we can pay you a return when we're going on the downside. So yes and no is the answer to that question. The next question, do you provide corporate services for companies, businesses and employees?
So that's a very commonly asked question, and I suppose at my end of the working day, we do provide services for corporates if they want to maybe insure multiple directors, but each director would have to take out a policy in their own name. I think maybe your questioner is hinting more maybe towards a group scheme, whether it's health insurance or maybe smaller amounts of life cover. We don't provide that, or I don't cover that specifically myself, but I'm sure you've got reasonable channels within the framework of Holborn to do that.
Yeah, just to jump in there, we can do that if someone's looking for group company, health insurance, life insurance, key man insurance on a smaller scale. Of course, we can do that for you. Next question, can I get cover for my wife and kids / family?
You can. Again, let me tell you a little story if you guys have time. One of the cases, about 5 years ago I did, and I was helping a consultant with their client who went ahead and did $5 million of cover. Sitting in on that meeting, he wasn't even meant to be there, was another chap, and he was his cousin. And he went ahead with a $3 million case. And it was a wonderful day because it was a wonderful-ish day because he was declined. And I said to the insurance company, let's postpone him. So they did. And 6 months later, we got him accepted. He was so happy. He then said, well, can my wife do a policy? And the answer was yes. And she also did $3 million. In fact, it was the fastest case Continental have ever done. From start to finish, it was 7 days. It's always as fast as the slowest horse. We know that, but this was a really fast one. And coincidentally, I met him for a cup of tea in London, and they thought they couldn't have children many years ago. And since he became healthy, they've got a lovely baby daughter, and they've gone ahead and they're now looking to insure her. So the rule for the children is yes, as long as one of the parents has the same level of cover or more, doesn't have to be with the same provider or even via Continental or you, as long as they can demonstrate we've also got insurance, then the answer is yes.
That's great. Can smokers or people with underlying medical conditions get protected via you?
Yes, they can. A very sweeping statement, but yes, they can. People that smoke, patch, gum, shisha, pipe, cigar, vape are classified as smokers, and they would be a little bit more expensive to insure, as you would expect. But at the same time, I've had a lot of clients who said, look, I have been a smoker. So when did you give up? A month ago. So what we can do there is do a quit smoking incentive. So we can give them non-smoking rates for say 3 years, during which they then demonstrate they have given up smoking, which is called a cotinine test. It's basically to see if they've been smoking. And if that's negative, then they would continue to get non-smoker rates, which is very, very possible. Underlying health conditions, there's a whole variety there. And we've got some very interesting ones going on just now. I've got one case I can think of where the client has been declined by 4 insurance companies, but I've got one looking at it who said, yeah, we think we can do this. The beauty of Michael and I working together is I have an amazing team. I can't take credit for any of this myself. I have an amazing team who will go and find amongst our contacts someone who could look to help that. But yes, we have covered some people with fairly extraordinary medical conditions over the years and will continue to do so. So if you've had a heart attack, if you've had a stent put in, if you're diabetic, don't assume you won't get insurance, because the chances are you will.
No, I agree. And I think anybody in that position should definitely reach out and ask the question. So if you don't ask, you don't get. Two more questions have come through. Is there multiple companies offering this type of cover?
Yes, most definitely. So I think at the moment we are working with about 6 or 7 different companies offering whole of life insurance, universal life. So some may cover better in some regions and others may cover better in other regions. So I know which ones to use. And for example, some may say, well, if a client's living in Cape Town, they'll be less expensive than someone living in Johannesburg. If a client's living in Nigeria, they'll be rated, whereas with another company, they won't be. So it's all about knowing your stuff, which we hopefully do, and knowing which is the most appropriate policy for a client. So yes, we have a very long list of insurance providers with whom we've got a very long standing relationship, and they are friends. We don't have any egos, no hierarchy. Just as with you, we're all on the same page trying to do the best thing for our clients.
That's great. And it's great to hear that. There's one more question that I will answer, and it's simply, how do I get a quote? Very easy. Scan the QR code and book a meeting with me, or send me an email. Obviously, we will need some details, etc., and it will be quite good to have a discussion before we do the quote. But please send over your details, and we'll be happy to reach out to you and have that conversation and get the ball rolling. Right, that's it for the questions, Richard. Once again, I really do want to thank you for joining us today. You've been a fantastic speaker, and I hope everybody listening has taken in a lot of information. And I'm sure we will be speaking to you soon. And once again, thank you everybody for joining. And I'm sure we will see you on our next series of webinars soon. Have a good evening, everybody.